Compared to more than 3 decades of breathtaking double-digit growth, China's recent economic data signals a slowdown. The popularity of the catchphrase marks a shift in the mindset of the Chinese people, but lower growth will likely continue and is not a sign of failure. Instead, a lack of reform can be fatal to long-term sustainable growth. The Xinhua editorial argues that on this point, the projections of the pessimists are wrong. China's economy has entered a new normal of slower but high-quality growth. 2014 has witnessed promising signs of a transition in China's economy. Consumption has, for the first time, exceeded that of investment in terms of China's economic output. The growth of the services sector continues to outpace that of secondary sectors. A consumption-led, services-driven economy is gradually taking shape.
It's rational for investment to slow down. That's what's been happening. And what's good is that investment has slowed down, but consumption has continued very strong. So that's why China's growth is really quite good. It'll probably end up being about 7.3% for 2014.
Perhaps most notably, China's tech industry has bloomed in recent years. More than a dozen Chinese internet companies launched their initial public offerings in the United States in 2014. The Chinese economy has emerged stronger than anticipated. A growth of about 7% isn't high-hanging fruit for next year. That growth, which is still high, would give China abundant headroom to push through painful reforms. For China, the days of super rapid growth have come to an end, leaving the current leadership with obstacles as well as opportunities. The world must be patient as China makes much-needed change in its economy.